If you're 65 or older, the government already quietly moved you into a different category of taxpayer, and nobody called to tell you. Every year, the county sends you the same property tax bill. Medicare sends you a premium bill based on income you earned 2 years ago, whether you're still earning it or not. Your bank still charges you the same fees. Every one of those bills is written with one quiet assumption baked in, that you don't know what you're legally allowed to skip. I want to be straight with you before we start. If you own your home outright and you're comfortable, you might assume none of this applies to you. If you're living mainly on Social Security, you might assume the opposite, that this is only for people with money already. Both are wrong. I'll tell you exactly who qualifies for each one as we go. So stick with me, because we're talking real money here that every retiree is losing every year. Nobody tells you that there are at least 15 separate federal and state programs built specifically to reduce or eliminate what you're paying right now. Here's the catch, though. None of this adjusts itself. No agency sends a letter. No refund shows up automatically. You have to know about them, and you have to ask. Today, I'll walk you through the 9 that matter most, plus alert you to 6 additional programs to save you even more every year, and what to do about each, step by step. I rank these by real dollar impact, biggest first, using the actual thresholds for 2026. And at the end, I'm going to add up all 15, honestly, not the inflated number, the real one. It's not what you'd guess. Let's get into it. Number 1. Senior property tax exemptions and freezes. Most states run some version of a homestead exemption, a tax freeze, or a circuit breaker credit for homeowners over a certain age, usually 65, sometimes 62. According to AARP's state-by-state property tax guide, the size of the break ranges from a few $100s a year up into 5 figures, depending on your state and your home's assessed value. On a $300,000 home, that can mean anywhere from $1,000 to $10,000 or more back in your pocket every single year, for as long as you own the home. Texas, for example, adds an extra $10,000 homestead exemption on top of the standard one once you turn 65, and freezes your school district property tax bill at that year's rate for as long as you own the home, even if your home's value keeps climbing. Other states run the mechanism differently, but the underlying idea shows up almost everywhere. Age is worth real money on this bill. Here's the catch. Almost none of these apply automatically. You have to file an application with your county assessor, and most assessors won't call you to remind you. Some states even allow retroactive filing if you missed it, which means there's a real chance you've already overpaid, and you can still get some of it back. Number 2. Medicare premium adjustments, specifically getting your IRMAA surcharge reduced. Here's the part that surprises almost everyone. Medicare doesn't look at what you're earning right now. It looks at your tax return from 2 years ago. In 2026, the standard Part B premium is $202.90 a month. But if your modified adjusted gross income was above $109,000 as a single filer, or $218,000 filing jointly on your 2024 return, Medicare bumps you into a surcharge bracket. And at the very first tier, your premium jumps to $284.10 a month. That's over $1,000 a year in extra premium, and it climbs from there at higher income tiers. Now here's the reveal. If your income has dropped since that return, you retired, you stopped working, a spouse passed away, you got divorced, Medicare has a form for exactly this situation. It's called the SSA 44, a life-changing event appeal, and it lets you tell Social Security your current income instead of the stale 2-year-old number. Picture a retiree who worked through age 63, earning $140,000, then fully retired. 2 years later, at 65, Medicare is still looking at that $140,000 return and charging the surcharge rate, even though actual household income has dropped to $60,000. Filing the SSA 44 with the current $60,000 figure moves the premium back down to the standard $202.90 rate, saving roughly $1,000 in year 1 alone, and every year after until income rises again. Retirees who file this and get approved can drop back down a full bracket or more, worth $1,000 to $8,000 a year, depending how far the correction goes. Most people who qualify never file it because nobody mails you a reminder that says, "Hey, you can appeal this." Number 3. Social Security taxation strategy. This is the one almost nobody optimizes because almost nobody realizes it's optimizable. The thresholds that determine how much of your Social Security check gets taxed are $25,000 and $34,000 for single filers, $32,000 and $44,000 for married couples. And here's the detail that should bother you. Those numbers have not moved since 1993. They are not indexed for inflation. Below the first threshold, 0% of your benefit is taxed. Between the two thresholds, up to 50% becomes taxable. Above the top threshold, up to 85% is taxable, for life. The lever you actually control is called provisional income, your adjusted gross income plus tax-exempt interest, plus half your Social Security benefit. Manage what shows up in that formula, timing a Roth conversion, controlling capital gains recognition, choosing which account you pull from, and you can keep yourself under a threshold that determines whether the IRS touches your benefit at all. Retirees who actively manage this typically save $500 to $5,000 or more a year. Every year they stay under the line. Hold that number. We're coming back to it in a few minutes, because there's a second lever that stacks directly on top of this one. Number 4. State-level retirement income exemptions. This is entirely dependent on your state, so the range is wide, but the size of the gap will surprise you. According to Kiplinger's state-by-state retirement tax maps, a little over a dozen states charge zero state income tax on Social Security, pensions, and retirement account withdrawals combined. States like Florida, Texas, Nevada, and Washington have no state income tax at all, so none of it touches retirement income. Other states like Illinois, Mississippi, and Pennsylvania do tax income generally but carve out a specific exemption for retirement income. And then there are states that tax all of it like ordinary income, no exceptions. The difference for an identical retiree, same withdrawal, same pension, living in a tax-friendly state versus a high-tax state can run $500 to $10,000 or more every year. And this isn't a one-time credit, it's every year you live there. If you're anywhere near a decision about where to retire, this single line item is worth running the actual numbers on before you sign anything. Number 5. Capital gains planning and the home sale exclusion. This is the biggest number on this entire list, and it's not close. Under Section 121 of the tax code, when you sell your primary home, the first $250,000 of gain is tax-free if you're single, $500,000 if you're married filing jointly, as long as you owned and lived in it for at least 2 of the last 5 years. On top of that, there's a second layer most retirees never use on purpose, the 0% long-term capital gains bracket. For 2026, if your taxable income after deductions stays under $49,450 single or $98,900 married filing jointly, any long-term capital gains you realize that year are taxed at 0% federally. Not a lower rate, 0. A retiree living mainly on Social Security and a modest pension in a lower income year can deliberately sell appreciated stock up to that ceiling and pay nothing on the gain. Do that every year you're in a low income stretch instead of dumping everything in one year, and you can legally realize 5 figures of gain, tax-free, over and over. Combined, careful capital gains and home sale planning is worth anywhere from $5,000 to over $100,000. And for someone selling a long-held home in a hot market, that top end is not hypothetical. It's the single largest reason this entire list exists. Number 6. Qualified charitable distributions. If you're 70 and a half or older and you give to charity anyway, this one is close to free money, and it connects directly back to number 3. Instead of withdrawing from your IRA, paying tax on it, and then writing a check to your church or a nonprofit, a QCD sends the money directly from your IRA to the charity. And here's the key detail. It never touches your adjusted gross income in the first place. It's not a deduction you claim after the fact. The income is simply excluded, full stop. Since AGI is the biggest input into the provisional income formula from number 3, a large enough QCD can pull your provisional income back under a Social Security taxation threshold in a way that a regular withdrawal followed by a charitable deduction never could. In 2026, the IRS allows up to $111,000 per person this way. If you're taking required minimum distributions, a QCD counts toward that requirement too, which means it can lower your AGI, keep you under the Medicare IRMAA threshold from a minute ago, reduce how much of your Social Security check gets taxed, and satisfy your giving, all in the same transaction. Depending on how much you already give and your tax bracket, that's worth $1,000 to $20,000 or more a year that simply stops showing up as income. Real quick, if you're not subscribed yet, please take a second to do that now. This channel is all about helping people make smarter financial decisions before and during retirement, from taxes and investing to Social Security, Medicare, estate planning, and the hidden rules that can quietly cost you thousands of dollars. My goal is simple: help you protect the wealth you spent decades building so you can actually fund the retirement you planned for. If that sounds valuable to you, subscribe now and let's continue. Number 7. The Medicare Part D out-of-pocket cap. This one is brand new, and a lot of retirees are still paying like it doesn't exist. Starting in 2025, under the Inflation Reduction Act, Medicare put a hard annual ceiling on what you pay out of pocket for prescription drugs through Part D. For 2026, that cap is $2,100. Once you hit it, your plan covers 100% of your covered prescriptions for the rest of the year. No more copays, no more coinsurance, nothing in the donut hole, because the donut hole doesn't exist anymore. For retirees managing an expensive chronic condition, this replaces what used to be $500 to $3,000 or more a year in drug costs that had no ceiling at all. Before this cap existed, some retirees on specialty medications were paying thousands of dollars every single month straight through the coverage gap, with no limit in sight until the calendar reset in January. If you haven't looked at your Part D plan since before 2025, it's worth checking. The math on your specific drugs may have changed more than you think, and some plans also let you spread that $2,100 across monthly payments instead of paying it in a lump sum early in the year. Number 8. Medicare Savings Programs. These cover your Part B premium, and sometimes your deductibles and coinsurance too, for retirees under specific income limits. There are 3 tiers. For 2026, QMB covers a single person with monthly income up to $1,350, or $1,824 for a couple. SLMB extends that to $1,616 single, $2,184 couple. QI reaches up to $1,816 single, $2,455 couple. Depending which tier you qualify for, that's $2,000 to $4,000 or more a year in premiums you'd otherwise pay every single month. Here's the uncomfortable statistic. Data from KFF shows that only about 39% of people who are eligible for a Medicare savings program are actually enrolled in one. That means roughly 6 out of 10 eligible people are leaving this money on the table every year because the application isn't automatic. You have to apply through your state Medicaid office. Number 9. Enhanced Standard Deductions. And this one is brand new enough that most retirees haven't caught up to it yet. On top of the regular standard deduction, taxpayers 65 and older already get an extra $2,050 if single, or $1,650 per spouse if married. But there's something new layered on top of that. Starting in 2025 and running through 2028 only, the One Big Beautiful Bill Act added a bonus senior deduction of $6,000 per person, $12,000 for a married couple where both spouses qualify, available whether you itemize or take the standard deduction. It phases out above $75,000 of modified adjusted gross income for single filers, $150,000 for joint filers. This one is below the line. It reduces your taxable income, not your AGI, so it doesn't move the Social Security provisional income math from number 3 the way the QCD does. But taxable income is still the number your actual tax bill is calculated on, and a 4-year window most retirees don't know exists yet is worth planning around while it's here. Combined, these two enhanced deductions are worth $500 to $5,000 or more a year in reduced federal tax through 2028. Okay, the 9 programs we just detailed above are the big ones that can really add up to save you thousands of dollars a year depending on your situation. But coming up are 6 more programs you'll also want to know about that can save you $100 to $2,000 annually. So, not chump change. And at the end, I'll add up all 15 so you can see what a realistic amount of total savings you can achieve when you take advantage of these programs no one else is telling you about. Then I'll also tell you step by step how to do it so you can take action right away. Let's keep going. Number 10. Estimated tax penalty relief. If you're retired and pulling income from multiple places, a pension, an IRA, part-time consulting, investment income, the IRS doesn't automatically withhold enough, and if you underpay through the year, they charge a penalty on top of what you owed. But the IRS has a safe harbor rule. Pay at least 90% of what you owe this year, or 110% of what you owed last year if your adjusted gross income was above $150,000, and the penalty doesn't apply, even if your final bill is bigger than what you paid in. A lot of retirees pay a penalty they didn't have to pay simply because nobody explained the safe harbor math to them. Getting this right is worth $100 to $2,000 or more back, depending on how far off your withholding was. Number 11. LIHEAP, the Low Income Home Energy Assistance Program. This one covers part of your heating and cooling bill directly, and it's administered state by state through the Department of Health and Human Services. Benefits typically run $200 to $2,000 or more per season, depending on your state, your climate, and your fuel type. A retiree heating an old house with oil in a cold winter state sees a very different number than someone with a mild climate and a modern heat pump. It's income tested, so it won't reach every viewer of this channel, but for retirees on a fixed income watching a heating bill climb every winter, this is real, recurring relief that most people never apply for because they've never heard the program's name. Number 12. Free tax preparation. The IRS runs 2 volunteer programs that most retirees have never heard of. VITA is open to anyone generally earning $67,000 or less. TCE, Tax Counseling for the Elderly, has no income limit at all, and it specifically trains volunteers on the tax issues unique to retirees: Social Security taxation, pension income, RMDs. Both are completely free, staffed by IRS-certified volunteers, and available through the IRS's site locator. If you're currently paying $150 to $800 a year for a preparer to handle a fairly standard retirement return, TCE alone might make that an unnecessary expense. Before we get to the last 3, here's a quick gut check, because 12 items is a lot to hold in your head at once. If you only act on 3 things from this entire list, make them these. File for your state's senior property tax exemption if you have it, because it's the highest probability item here and it resets every year you don't claim it. Check whether your Medicare premium is still based on stale income, because that's a 5-minute form with a real dollar payoff. And if you're anywhere close to selling a long-held home, get the home sale exclusion math right before you list it, because that's the one line item on this entire list large enough to change your retirement by itself. And numbers 13 through 15 are smaller, but I'm ending on them on purpose, because the whole point of this video is that the money you're not leaving on the table adds up, even in small pieces. 13. Phone and internet discounts through the FCC's Lifeline program, worth up to $9.25 a month, or about $111 a year for qualifying households. And many carriers stack an additional senior discount on top of that. 14. Bank fee waivers. Plenty of banks and credit unions quietly waive monthly maintenance fees, minimum balance requirements, or check printing costs for account holders over 65. It's rarely advertised, and it almost always just requires asking. 15. Free notary services. Many banks and credit unions notarize documents at no charge for account holders, and some senior centers offer it too. A small thing, but one more small bill you don't have to pay. And look, if you're the kind of person who already has a CPA and figures a video like this can't possibly apply to you, I'd push back on that a little. A good preparer optimizes the returns sitting in front of them for this year. Most of what's on this list only pays off when someone is tracking the multi-year interaction between your property tax filing, your Medicare premium, your Social Security taxation, and your capital gains timing all at once, across years. That's not a knock on preparers, it's just not the job most of them are hired to do. Now, I want to be honest about who this list is actually for, because a few of these are income tested, and if you've built real savings, some of them won't reach you. Medicare savings programs cap out around $1,350 to $1,816 a month for a single person, well under what most of this channel's audience lives on. LIHEAP is similarly income tested at the state level. If your household income sits meaningfully above those lines, numbers 8 and 11 on this list simply aren't going to apply to you, and that's fine. That's not a flaw in the list, that's just how targeted assistance programs work. But notice something. The two biggest numbers on this entire list, the home sale exclusion and Social Security taxation management, aren't income tested at all. Neither is the property tax exemption. Neither is the QCD. They're not for people who are struggling. They're for anyone who owns a home, gives to charity, or collects a Social Security check, which is most of the people watching this. So let's actually add this up, and I want to do it carefully because just stacking all 15 ranges together would be dishonest. That's exactly the kind of clickbait math this video is trying to correct. Some of these are recurring, every single year. Others are one-time or situational. So here's the honest version, broken into two buckets instead of one big number. Bucket 1. Recurring, broadly applicable, not income tested. Property tax exemption, conservatively $1,000. IRMAA correction if it applies to you, $1,000. Social Security tax management at the low end, $500. The enhanced deductions, $500. That's a conservative $3,000 a year, every year, before you've touched a single income-tested program. And if you land near the top of every one of those same four ranges at once, that stack can run past $20,000. Realistically, most retirees will land somewhere between those two numbers, not at either extreme. Bucket 2. One-time or situational, but potentially enormous. The home sale exclusion and QCDs if you give to charity. Sell a long-held home during retirement, and the exclusion alone can dwarf everything in Bucket 1 combined, in a single tax year. That's the honest total, a few $1,000s a year, every year, on autopilot once you set it up, plus the possibility of a 5- or 6-figure event on top of that, once, when you sell. Here's the 4-step version of what to actually do with this. Step 1. Pull your last 2 tax returns and your most recent property tax bill and check your state's homestead exemption rules. That's the highest probability, lowest effort item on this list. And if you missed it in prior years, check whether your county allows retroactive filing before you assume that money is gone. Step 2. If your income dropped in the last 2 years for any reason, file Form SSA 44 with Social Security to get your Medicare premium recalculated off your current income, not your old one. The form is free, it's a handful of pages, and Social Security processes it directly. Step 3. Before you take any large withdrawal, sale, or Roth conversion this year, run it against 3 thresholds at once, not just one. The Social Security provisional income line from number 3, the Medicare IRMAA line from number 2, and the 0% capital gain ceiling from number 5. A withdrawal that looks smart against any single threshold can quietly push you across a different one you weren't even thinking about. Step 4. If you don't already have a tax preparer, call your local TCE site before you pay someone. It's free, and it's specifically trained on exactly the situations you're dealing with: Social Security taxation, pension income, RMDs, and QCDs. Here's what I actually want you to watch for going forward. Your magi every year before you make any big financial move. That's the one number that touches almost everything on this list: Social Security taxation, Medicare IRMAA, the standard deduction phase-out. Move it a few $1,000s in the wrong direction at the wrong time, and you can trigger 2 or 3 of these penalties in the same tax year without meaning to. Move it deliberately, and you can avoid nearly all of them. The real trap here isn't any single bill on this list. It's the assumption that if a program existed and mattered, someone would have already told you about it. Nobody's job is to tell you. Not the county, not Medicare, not your bank. Their job is to send the bill. Your job is knowing which ones you don't actually owe. 15 programs, most of them decades old, none of them hiding, just sitting behind an application form nobody hands you. Tell me in the comments, which item above helped you the most? Which ones didn't you know about before? Or which one surprised you the most? If you found this video helpful, I'd really appreciate it if you'd give it a like. It tells YouTube this is the kind of information people need to see. And if you're not already subscribed, be sure to subscribe and turn on notifications. Every week, I share practical strategies to help you make smarter financial decisions before retirement and better financial choices throughout retirement, from investing in taxes to retirement income, Social Security, Medicare, estate planning, and the money mistakes that can quietly cost you thousands. Thanks for watching, and I'll see you in the next video.